the last session on amendments of income tax, we have Vishwas Panjiar, partner Nangia Andersen LLP, to take us on the topic M&A and startup compliances changes. Vishwas Panjiar is an expert in corporate and international taxation, company law, and exchange control with over 16 years of experience. He advises clients in various industries and manages key accounts. He is a frequent speaker at professional forums and holds honorary positions at the Roundtable India. A very good evening, Vishwas, and welcome to the event today.
Good evening. Good evening. Thank you so much, Ridhima and Naveen, for this opportunity. One thing I'd like to really compliment, considering that this is a marathon, and with I being perhaps the 10th speaker or 9th speaker, right? You're not on time. At least my clock says it's 5:45, which is exactly the time that you wrote on your email.
Absolutely.
I like to believe that this is well planned rather than a coincidence. Great. So when Naveen asked me to present for, my screen is visible, Ridhima?
Yes. The voice is getting echoed a bit.
Okay. I'll come closer. Is this better, or you want me to put on?
Better.
Okay. Great. So when Naveen asked me to present for the M&A and startups, my thought was that when the budget actually came and there was so little for me to talk about, I was wondering whether this would go on for 45 minutes. So I would encourage the participants to ask questions if they have any. Right. So I like to begin. These are the 4 topics that I would want to cover. Just that you know that what's coming about. The first thing that I wanted to cover was the TCS. Now, TCS on LRS is, I mean, one might say that it's ostensibly not really a M&A topic, but there is a relationship with the structuring opportunities that we have, and therefore I wanted to bring this up. The rate of TCS has been raised to 20% from the existing 5% on LRS. Now, this is an important consideration now, right? Because it does affect the cash flow, and it is an important consideration as far as overseas investments are concerned. So, as an individual, if I was to set up a company or make an investment or set up a structure, anything outside India, I have to be mindful that whatever money that I send out, there would be an additional 20% TCS, and this is the money mind me that I'm sending out of my tax-paid income, out of my saving, but still there would be a TCS. That's the way TCS works. On the other hand, if I choose to make the same structure through an entity of mine in India, these regulations are not going to affect, because LRS is a regulation which is defined in the FEMA and which is available to a resident individual and not to companies. So even if, let's say, if a promoter is a non-resident otherwise and he has money in India in another account or any other account in India, and he sends money or he sets up a structure, still these regulations or this proposed change would not affect him. But what is interesting to note is that only this year, I mean, in August this year, the ODI regulations were revamped to a lot of extent, both for ODI for individuals as well as for companies. And these changes were to a large extent pragmatic and was encouraging overseas investment. Now, come February, the proposed budget has made this TCS to be 20% from the existing 5%, which is a lot of stance can be said to be discouraging people for making investments or making structures outside India. Now, these 2 changes, which will pretty much happen in the same year, one by DI in the overseas regulations and one in this budget, there is a bit of an incoherence in terms of the policy language. There is one could say that is blowing hot and cold, and it's very difficult to perhaps get the sentiment. Well, obviously, this is one of the reasons here was to discourage movement of capital or foreign exchange out of the country. But given the comfortable position that we are in foreign exchange, it's a little surprising. Moving on to the next topic that I would want to cover is actually section 54 and 54F. Although I didn't attend this session in the morning, I believe there was something on the capital gains, and this honestly is more on a capital gains provisions, or it probably fits better into a capital gains section of this presentation. But again, there's a relationship in why I wanted to bring this up. Both 54 and 54F are sections that provide deduction from capital gains. 54 being a section where if you buy one roof by selling another roof and you incur capital gains in that process, it provides that exemption. And 54F being other than residential assets. If you sell some other long-term capital asset and buy a house for yourself, then there is a deduction available. Now, the ethos behind section 54F is that in India and probably in other parts of the world as well, buying a residential house is one of the very significant events in anyone's life. It's a very capital intensive, milestone. So which would basically involve people selling a lot of their assets or something that they've held for a long time. Perhaps you've held a share for a long time and you now want to exit out of that and buy a house for yourself. There was no limit on such a deduction. For example, if you sell a share of a company that you held for a long time and you have a capital gain, or you get a proceed of, let's say, 50 crores or 25 crores, and you invest the entire 25 crores in buying a house for yourself, and obviously subject to some other conditions that the section 54 provides, you don't have to pay any capital gains as of now. But now the budget proposes a cap that you could only invest, any investment in excess of 10 crores would be ignored. So one of the practical or suggestions that can be given right now is that if you have let's say if you have a startup investment and which has already matured, you're one of the early investors and it has matured, and you're thinking of making an exit next year, might as well do it this year. Because if you sell your startup investment or any other investment within March, and you have a huge proceeds and a huge capital gains, and you invest all of that in buying a house for yourself, still there is no capital gains tax that you have to pay. This is an example which would perhaps make it a little bit more clearer. There's another aspect with respect to house property of interest which could be covered in the example, but I'm not covering that within the topic that has been allocated to me. But as you would see that in this example, if your sale consideration was 45 and you invested the entire 45 as of now within this financial year, you don't have to pay any capital gains tax. Whereas if this amendment takes effect, your capital gains would be limited. You still will have to, the amount of investment that has to be limited to 10 crores, and therefore the residual amount would still result in a capital. Startups. Right. So there are two buckets of changes that has come in startup. One bucket of changes for the eligible startups, and the other benefit is for the other startups. Now, the eligible startups are those which have to be approved by the interministerial board and has a turnover of less than 100 crores. So now, the number of this has been criticized quite too often, so I'm not going to spend too much time, but the number of startups which are actually eligible or have been approved by the interministerial board. There are several which have been approved by the DPIIT, but or the ones which are put in the intermiddle are so little, but it's one sometimes thinks that whether it deserves time or in a budget speech or of the parliament or even this session. But since it's there on the topic, so I must cover it. We had moved away from profit-based deductions a long time ago, but one of the profit-based deduction that was introduced for startups was that there was a 100% of the profit was deductible in the 3 years out of the first 10 years. Now, this was available to a startup which is incorporated till 31st March of 23, which means that March of 23 was the sunset clause for those startups. This has been extended by another year. Right. So similarly, there was a benefit available for change in shareholding. Just for the uninitiated, one must mention the background that in case there is a change in shareholding of a company to beyond 51%, the losses are losses lapse. They are not available. And we know that startups by nature, there are multiple rounds of funding that happens, and the founders or the initial shareholders who were maybe the majority or 100% of the shareholder when most of the losses were incurred, slowly gets reduced to a minority. So they would have lost the benefit of the losses they've incurred, or they will not be able to set off those losses that they incurred in the earlier years. But first, if you're a startup, an eligible startup, then the existing provision said that in the first 7 years, as long as the shareholders continue, even if they are below 51%, the losses will still be available. Now, this 7 years has now been increased to 10 years. There's another set of case where the founders exit is in case of a consolidation or takeover. But mind you, this benefit was never available to them. Right? If a founders exit completely, they're no longer a shareholder at all, then the losses would expire. So this would perhaps this is another consideration for the investments in consolidation and transactions and M&A transactions in startups that perhaps the founders, even if there is no one-off model or there is no other commercial reasons for the shareholders, the existing earlier shareholders to continue, they may still have to do that for the purpose of keeping the brought forward losses in mind. Moving on to the second bunch, which is the let's say the specified startups. I use a different term just to help you appreciate the difference. Specified startups are startups which the conditions are mentioned. They don't need to be approved by the interministerial board. They are the DPIT recognized startup, which is clearly the bigger lot. And it makes much more sense to talk about the benefits which are available to them. Now, there was if you receive a premium on the which is in excess for a prescriptive value of the shares of the company, those become taxable in the hand of the company. So there was an exemption available to them. Now, which is whether from a resident or non-resident. Now, there was a 2019. Those notifications were made available to all eligible to these eligible startups which have been mentioned now.
Vishwas, all okay?
Yeah. So sorry. So one second. Yeah. So now this is there is as long as these the conditions of these are met, which is that your turnover is below 25 crores and and you are registered with DPIP, where the premium that you receive on the shares, whether from a resident or a non-resident, that would not be there would not be any tax on the setup for that investment. The last of the topic that I would want to cover is again MMR, which stands for which is an acronym for maximum marginal rate. This again is I'll give me a moment to explain how this is how this fits into the M&A section of this presentation. So one of the biggest reliefs that is there is the headline rate of tax, which is there in the super rich, that has come down from 42.74 to 39%. That is, or has been proposed to be brought down from 42.74% to 39%. Now, this has got another effect also, that in case of a lot of these HMIs and high net worth families, they do a succession planning and they use various structures. A trust is a very common way, very common structure that is being used for succession planning. Now, trusts are taxed like an AOP, and in most cases than not, the AOP would be taxed at a maximum marginal rate. So effectively, what needs to be evaluated and considered is that even in such cases when there is a succession planning, this not only affects the HMIs in their personal hands when they move to or they choose the new tax regime, which is now with this change is the most obvious choice for people with high income in the personal hands to use the new tax regime. But even for the trusts where the assets are moving, and as an action or as a estate planning exercise, even for those, the maximum marginal rate or the MMR has come down, and which is a welcome move. So it's not only in the personal hands, but also post restructuring. Even if you're bringing in a trust structure in your succession planning, even in those cases, the MMR is going to the reduction in MMR is going to be helpful for these structures. That's pretty much all I had, really. And Ridhima, if there are any questions, I would be happy to answer. I don't know how we're doing in time, but
we do have a good time. So certainly I'll ask a few queries which we have.
Sure.
I think the 20% TCS is something which is going to have a lot of debate in the coming future, correct?
Yes.
So what are your views as in why the government had a thought of putting such a high rate on the transactions? Because this is something
it completely baffles me, right? That's exactly what I wanted to what I mentioned is that in so recently, right, the ODI regulations have been revamped, and mind you, the changes that have happened in the ODI regulations, they have been the demands of various family offices and people wanting to make investments for a long time. Some of these changes that have come, it was a long-standing demand which was only conceded, and a liberal or a more pragmatic face was shown. Right, and our foreign exchange results are very good, doing very well. Everyone is aware about that, right? They're doing very well. So, we move from summer to winter, and suddenly there is a 20% on all RS payments. So, which is quite strange. But I mean, it was important to also understand that why I mentioned only about LRS here, right? That but if you're making if you're making as a company, you're making an investment, it's not applicable. But if a company you're buying an overseas store, it is still applicable, right? Because that's not LRS, that's applicable to everyone. So if there is a 5 lakh, for example, expense for for a tour overseas, it's now going to take out 6 lakhs from the company's exchequer. So this is, I think it's a little bit of it's beyond a tax collection mechanism, right? Because it's definitely 20% cannot be a tracing mechanism. 5% was enough to trace income, right? So for example, 195, there's only 1%. If it's only a matter of tracing, so
Right.
20% is a little overkill, definitely overkill.
So are the representations being made to reduce the rate?
I won't be surprised if it comes down. I won't be surprised if it does actually.
Yeah, because people will face a genuine difficulty. Like many of the students go abroad, their parents sending living expenses. Will they be covered here?
If it's funded by loan, it is not, but otherwise it is.
Yeah, because education, when we talk about education, there's education loan, right? Which is other way 0.5%. And then coming to education related part, it is 5%. But living expenses.
I have. Living expenses would not be here.
So living expenses would attract this 20%, you're saying?
Education related, I would imagine that it will still be 20%.
Quite a hole in the pocket.
Out of loan, 0.5%. If it's not out of loan, but still a curriculum expense, 5%. If not none of the two, then 20%. Yeah.
Pretty tough. I think we have a lot of questions coming here. So does the threshold limit of 7 lakhs per year, this is one of our attendees asked, would apply for remittance made under LRS other than education fees or medical purposes, which is applicable for the new levy? I think this is.
So sorry, what's the question? Can you repeat that?
One sec. So the question in our chat box is, does the threshold limit of 7 lakhs per year is for remittance under LRS other than education fees or medical purpose apply for the levy of TCS? Or there is no threshold limit basically?
Oh, so is he asking that if somebody makes already made a remittance of 7 lakhs for medical purposes, then would this threshold become there? I would imagine that no, it has to be 7 lakhs other than the.
So other than is there any threshold limit or for 20% or is it flat?
Then just one second. No, there is 20%. There is no threshold limit.
Correct.
For the 20% slab, there is no threshold limit.
Correct. Right.
That's there. That element is very clearly there. That for other purposes there is no threshold.
Right. So another query which we have here is, taxing on funds from NR under section 56 will block the funds to startups, correct? So how is it going to boost the startup ecosystem in India?
Now that is another thing. I think because of that issue, we couldn't talk well on that, right? So now any FDI coming in, the rationale seems to be to now introduce the rationale in the first place to have 56 to 7B was that unrecorded, or it's a way of giving consideration, and it's like recirculation of black money, etc., etc. And the reason for excluding foreign investments or premium from shares issued to a non-resident was always that, first, obviously, to encourage investment is one aspect from overseas, and second is that if an investment is coming out from outside, that it's already a level of scrutiny it's going to, right? Because there is, I'm sure people are aware that there is a KYC norm that needs to be fulfilled, and there's a reporting mechanism within the within the let's say the RBI or the FEMA regulations, and not to mention that there are valuation mechanism, and anyhow, though the valuation mechanism is a floor there and not a ceiling, so it was always there. So it had enough, let's say, gatekeepers, there's no need of including having an anti-abuse tax. So now there seems to be a change in that thought process. Now there's still a lot of black money, or let's say not black money, like unaccounted or money, or this is a way of giving out considerations to many people. But I think it's I don't think it's fair to expose foreign investments to such a kind of such kind of regulation. That on one hand we are trying to show ourselves as a the story, and saying that they invest into India, make into India, And on the other hand, we are making it so prescriptive, right? And imagine somebody, a foreign investor, coming to India, making an investment. As far as Companies Act is concerned, as far as FEMA is concerned, there is a floor pricing that is available. And now in income tax, there is a ceiling pricing available. So what do? Then there is in the so to say, there is no what to say band. If otherwise in transfer pricing there is a concept of a band, but then if one goes strictly by what is there in statistics, there is no band.
Right.
You have to get that one price, that exactly one price. There is no and who on this planet is smart enough to have exact price of a share of a commodity like share. So it's over prescriptive and very straightjacketed. It makes it difficult.
So what will be the rate of tax on such investment under Section 56?
Other sources, so it will be the company's tax, right? It's tax on the company.
Next question we have is, how do we determine the value in such cases that capital infusion exceeds the fair market value? Will the DCF be acceptable, or can AO opt for the NAV method?
No, so okay. So this is also a big debate. As I said, while the audience here may be mostly for tax, so they would appreciate 56 more. But what you need to understand is that even in Section 42 Companies Act, also in private placement, you are required to have a valuation done. It's by a registered valuer. In FEMA also, you need to have a valuation done. It says any acceptable, globally acceptable valuation principle. But in income tax, no, nothing. Nobody applies when they have a formula of a DCF. But DCF still discounted cash flow still relies on the projection that one makes, an assumption a projection that's available, and the assumption one takes. Now, DCF methodologies otherwise also fits into the other two, right? In FEMA and income tax, in Companies Act and FEMA also, because that's for an ongoing business, that's the most acceptable way of making for an ongoing business, that's the most appropriate method of doing a share valuation. That is fine. So it's DCF would work. That's I don't think that's DCF would be a problem. But then there is some debate beyond this, is whether if it becomes like if it's a TP item, now it becomes an ALP. ALP has a concept of a band. Then you can have one DCF, one some other method, or some. It can go beyond that. Let's put it that way.
Great. One more we have. If startup starts making profit and would like to opt 115 BAA and BAB, either of them, what happens to the losses? Are they lost?
If they want to, so it's one of the 3 years that they want to take exemption. But if the loss is available, I would imagine why would anyone want to go for that?
Correct.
But okay, even if they do, it's okay. I probably have to check that. But it's a 6 year, right? It's a deduction from total income. The deduction comes first, or the share of losses comes first. So then I'll have to I'll probably have to come back to you with that answer.
Okay. So another TCS, I think TCS is pretty discussable topic.
TCS somebody else must have taken. I included TCS only from the perspective of what is there in the slide. So I mean, these thresholds 7%. I haven't applied myself so much on it, but anyhow, please go ahead.
But I'm telling this has been taken by all the speakers in Thoda Thoda part, and everyone had some or the other queries, because this is actually a very discussable topic, and because it has come as a shock, to be very honest, with
Yeah.
such a high rate. So, and people questioning all the transactions they look up to. So this question which we have is, will TCS provision would apply if I invest in overseas stocks through Indian brokers?
No, why not?
So,
Broker koi bhi ho, you'll have to buy the foreign exchange. So there is the so you have to buy the foreign exchange. Then yes, it is. If you're individual, you're buying the. The most let's say left, I don't know, very extremist statement would be then I start by -20, right? I stock पे invest करूँगा, मेरा stock अगले दिन 80 हो गया है, because 20 rupees I don't know when I'll get. The department will find one way or other to not give me or give me that refund or whatever. So, but that may be the most extremist way of dealing with that. That if I have to make an overseas investment of 100, the next day I start with 80, right? Like, so, but that's not too much. After all, only a tax collection mechanism, right? So they would. At some point in time you will be able to recoup that, but yeah, but why would one want to do that, right? If I have 100 if I have available 100 rupees disposable income to
right.
invest, right? If I invest in India, I'll be able to invest 100 rupees, but if I have to invest in overseas, I'll be able to invest only 18, because or whatever the little different calculation comes because of the grossing up, but I'll be able to invest about 80 only, because that's all I have to pay as TCS.
Right. And I think there are many such transactions coming up. Flight tickets, hotels separately, not booking through package, which is the tour part.
I won't know that. Also,
Debit card transactions overseas.
But I think that has been cast on the travel agent, right? I mean that. So if the one would say that, what if I buy from Agoda, which is not in India, and whether you will apply or not? So anyhow, let's
promote tourism in India then.
Yeah, tourism in India. Sure.
And one more. Just 1 second. Can the income of startup exceeding 1 second. Exceeding FMV under section 56 be taxed under section 115 BBE as unexplained income at the rate of 78%, or will the normal rate apply?
I think the income will have to be from profit, right? This will be other source. Again, I'll have to review and come back. I mean, if I can have the email address, or I'll email it to you, Raman. You can send back it. But I don't think it will be available. You accept take premium and then claim under 80. So anyhow, how many I don't know if anyone has the latest data. How many of these are what is the number of the eligible startup as of now? Has it crossed 1,000? I don't think that it has, right?
I really do need to check about this.
That's why I said there were two buckets, right? This one, this is available only to an eligible startup, which
it's 900. It's 900.
It hasn't passed 1,000, right?
Yeah.
Does it really deserve in a country 1.4 billion? Does it even deserve place in a budget speech or so this is more relevant, right? That now there is a even if there is a share premium coming from an overseas investor, but then the startup or otherwise, right? There is a tax now. Yeah.
Correct. Second. So yeah, I just got an updated figure from one of our colleagues. 89,000 startups recognized and 1,000 startups eligible for tax benefits.
So imagine, does it involve? So this that we spoke about, right? It is for 1,000 startups.
Correct. So what are your closing views on how the government can actually bend more ways beneficial for the startups to grow? Because as the numbers say, on what basis the government work more, both tax wise and environment wise and structure wise, so that the startup culture can be more organized?
So, I believe that you're asking from a tax perspective. What tax measures can be taken? There are various other things that can be done, right? So that's since the discussion about tax, one of the clear thing that needs to be done is that make this available to the entire startup community, right? There is a DPIIT, which is already registering startups based on certain conditions. Make these available to them. There is no point having a tax policy which is actually effective only on 1,000 people in a country of this size, or for that matter, perhaps country of any size. It's really not fruitful to have a policy or anything, any regime which is actually available only to 1,000 people. So I think that's the first thing that definitely that can be done from a tax perspective, right? So other demands would be quite radical. Like I mean, they're mostly non-tax actually, right? Because the startups um, for most of the years, right? The second amendment that you see, the period has been changed, brought forward losses, the benefit has been changed for 7 to 10 years. Is in a lot of sense an acknowledgement of the fact that it takes a startup period longer than 7 years to come from red to green. So tax may not necessarily be the biggest issue. Like this is the bigger issue, right? That you are that you try. If somebody is able to value a startup which is uh, beyond a mathematical formula or an empirical method that one can think of, then you should let them be. Let them value that and not try and tax and suspect that into that. Once something is recognized as a startup, you should let it flourish. So that's what I would say. From a tax perspective, that's all kind of. Most of the other things are like on a like an ecosystem things which is beyond that. A lot of things are already happening. So it is one of the thriving. India is one of the thriving economies as far as startups are concerned. Probably Mr. Kari can throw more light because one of the things is exit. Easier exit. One of the things that startups should be able to avail.
No, absolutely correct. I second this. So I think thank you so much, Vishwas, for such a helpful session on startup and also TCS. It was pleasure having you.
TCS, sure.
Okay, thank you so much.
Thank you.
So those were the insightful and education sessions on amendment to direct taxes.